You're watching Investor Insights, and in this video I'd like to talk about principles of investing and the current market frenzies. Now, it's taken me a while to prepare for this video because I've had to make a lot of notes, and I've got 3 screens in front of me with all the relevant data that I'm going to be giving you folks. I find that this video is a very important one to make because when you live in a bubble, it's very hard to see outside of it. And right now, with all the happy chatter that's out there and everybody on Wall Street slapping each other's backs and high-fiving each other, it's of great importance that you're able to see through all this rubbish, and you have to be able to look at the fundamentals and realize that basically most asset classes are in a speculative bubble phase. And I hope that this video can save you a crap load of monies from being poured into boxes of tissues when you realize that all your investments are going to go down the toilet when the next crisis hits. So first things first, I'd like to talk about what investing is. And this is by far the most important definition of this video, because a lot of people don't really think about what it is, and their sense of expectation or their sense of the meaning of the word is totally warped. So investing is when somebody puts their savings into an asset class that's going to grow over time through either income or capital gains, or a mixture of the two. Plain and simple. But another part of investing which is very important is that nominal numbers aren't just the be-all to end-all of investing. Just because an asset class goes up in value doesn't mean that your money is actually going up in value. So when most analysts or commentators come out and talk about, oh, the stock market is up 10% or 5%, that may be true, but nobody looks at inflation. And although this is the subject of another video, inflation is the key to a lot of your investment making decisions. So there's no point talking about just nominal returns when inflation is greater than your rate of return. So we have to expand the definition of investing as the allocation of one's savings into an asset class in expectation of returns that are greater than inflation. Plain and simple. Now, you've got to also look at the difference between investing and speculating. And right now I can tell you, if you're involved in the stock market, the real estate market, or the bond market, you're speculating. And I'm going to expand on this down the track. But speculation is when you don't do your homework and you jump headfirst into an investment or an asset class in the hope that a greater fool is going to pay more than what you paid for it. You're not looking at fundamentals. You're not looking at what you're getting involved in. All you're interested in is the acquisition of this asset and to sell it to the next bloke, hopefully in a very short time. This is a very dangerous game, because if you don't do your homework and the market turns on you and it turns out you're the biggest fool, you're going to get crushed. So speculators, beware. I'd also like to define several terms. I think first and foremost, the most important one is an asset. And you can look at various definitions on in various textbooks or websites or investment ebooks, whatever. But I would simply like to define an asset as something that pays you. Again, either through income or capital growth. And a liability is the opposite. A liability is something that costs you, plain and simple. So for the topic of this discussion, that's what we're going to talk about: assets as being something that pays you, and liabilities as things that cost you. Nice and simple. So we then have to talk about the various asset classes that you could put your savings in. So you've got the ones that we know most are stocks, you've got bonds, you've got real estate, you've got cash, and then the lesser well-known ones are things like foreign currencies. You've got commodities, which can be broken up into things like precious metals, agriculture, and energy. You've got collectibles and derivatives, but those latter ones aren't for you and I. They're just more for people who are from within that trade, and that's not even a topic of discussion anyway. When you invest, you don't only look at the returns that you expect or that you have worked out you're going to get. The one big thing that current market investors or speculators are totally ignoring are the risks. And basically the risks are the losses that you're going to incur as a result of you investing in these bubbles in the first place. So if you invest in a stock and the company has been fudging its numbers, whatever happens, the stock goes to naught, your risk is the total loss of your money. Right now, the Federal Reserve is removing all the risk or the perception of risk by making money so cheap and available that people are jumping into these bubbles in droves. Also, when it comes to investing, there's a very simple principle that people have to understand first and foremost. Excuse me. Is that what drives asset prices up or down? And that simple principle is supply and demand. When you have high demand for something and low supply, price is going to go up. And the converse, where you have low demand and high supply, well, the price is going to go down. Very simple principles, but ones that you have to keep in mind, because I'm going to talk about that a bit later. And then you've got to look at the macroeconomic and microeconomic fundamentals behind your investment. So with the macroeconomic, you're looking at the overall, the country in general, or the state in general. You have to look at things like GDP, unemployment. You've got to look at factors like inflation. That's more the overall picture of the economy. And when it comes to micro, you're looking at the individual asset in itself. It could be just the company that you're investing in, or the asset class that you're looking at, or just the sector in general. Another important part of investing is doing your homework. So you're looking at fundamental and technical analysis. Fundamental analysis is, again, looking at the macro and microeconomic situation that's going to affect the asset that you've purchased or invested in, and the technicals are just the momentum, or what the trend of the actual price action of your asset class is doing at the moment, whether it be trending up or trending down. A lot of people use technicals when they're doing very short-term trades to just try and make a quick dollar from a continuation or an extrapolation of the current move. Right now the markets are purely driven by technicals because fundamentals aren't there. If one looks at the fundamentals, you're going to find that all the numbers will make you vomit. There is not one single stock out there that is or bond or real estate number that is making any of these asset prices worth even looking at or investing in. So that's another important point to keep in mind. And the next thing I'd like to look at is important investing principles. There's several of them, but I'm just going to shorten them down and just briefly discuss what they are. The first and foremost is preservation of capital. If you don't have this in mind, you're already behind the 8 ball. Preservation of capital is the most important consideration before you make any investment out there. If you're speculating, I don't care. If you're speculating, you don't really care about preserving your capital because you believe that the next sucker is going to buy your investment of you at a more inflated price than what you paid for it. If you lose your capital, you're out of the game. Plain and simple. If you're broke, you can't invest anymore. You got to work again and save again. Right. Or unless you're an American and you just borrow more. But that's the subject of another video. Secondly, you have to understand your investment. You have to know, first of all, what you're investing in, what the risks are, what the rewards are, and sometimes the obligation and duties that are involved in actually owning the asset. So for example, if you buy a house, you can't just rent it out. You also have to look at maintaining it and paying the taxes and rates and whatever else that's involved in the actual keeping of the asset itself. And then you've got to look at the definition of a good investment. And to me, I'm going to make it a very simple one for you. A good investment is a profitable one. If you put money into an asset class and it makes you money, it was a good investment. If it makes you a truckload of money, then it's a great investment. Plain and simple. If you put money in an asset and it's stagnant or losing you money, it's not an asset. It's a liability because it's costing you money. Another important principles of investing, and sometimes people like myself would say that this should be the first one, but I still believe in preservation of capital. This is don't be a lemming. Don't follow the herd. Trust your own homework. Do your own research. Look beneath the surface at the asset class. Look at the fundamentals before you invest, irrespective of what everybody else does. Just because everybody else does something, doesn't mean that it's right. It's been proven in tech wreck, and it's been proven in the real estate bubble of 2006. Everybody piled into the Nasdaq stocks in 2000, they all got blown up. They piled into the housing market, they got blown up. So the herd, especially in bubbles, are wrong. And if you follow the herd, and therefore you didn't do your homework, you're going to get crushed. This is a very, very important principle. And another very simple principle that people tend to forget, or when they speculate, they just don't think about it, is it all comes down to one thing. To make money. And to make money, you have to do one thing and one thing only. That's to buy an asset at a low price and to sell it at a high price. it doesn't matter what the order is. So if you're shorting stocks, you can sell high and buy back low, but the principles is the same: buy low and sell high. There is no other way of making money on this planet. If you buy high and sell low, you're going to lose money. Plain and simple. One other important investing principle that this is one that's a lot of people tend to ignore, is knowing when to leave. Some people just don't understand this very simple concept. When you first enter an investment, when you first put your money down into an asset, you have to have expectations of what that asset is going to do for you, whether it be an income stream or a growth in its value. It doesn't matter. You have to have an expectation. And when your expectation is met, you should be happy, and you should either leave or start taking money off the table, because those gains can vaporize overnight, especially in a speculative market. But when I talk about speculating, I just want to make sure that you understand that investments aren't forever. There is always a time where you have to let go. And there's a lot of people out there who are married to their positions. And I think these guys will leave their wives before they will leave these positions. There are some people who are just stuck on the idea that every investment is for the long term, and in the long term things are going to pay off. Well, you know what? If you are a long-term investor of Enron, you wouldn't be breathing right now. If you were an investor in Pasminco years ago in Australia, that went to naught. I can think of probably 100 companies that went to naught. Circumstances change, management makes stupid decisions, government makes stupid decisions. And there comes a time when your expectations are met and you walk away. Plain and simple. Another consideration when investing, or something that you should not consider, this is a personal view, are tax implications. If all you think about is the tax implications of you exiting an investment or entering an investment, you've got your whole methodology all wrong. Because it doesn't matter what taxes you pay as long as you make money. And if you make a crap load of money, you're going to pay a crap load of taxes. You can't dodge that. Death and taxes. Anybody who is married to a position and is not willing to leave it because they think that they have to pay taxes, whether they're capital gains or whatever, then those guys can get wiped out if the market turns and all the gains that they've made on their investment turn into losses, and they've only got themselves to blame. And especially if all they were trying to do was save a little bit of tax. My philosophy is pay as much tax as possible, because it means that you've made a crap load of money. Plain and simple. And I think this, I've mentioned this earlier, but when you invest, your goal is to make money. And you never should lose sight of that principle. If you're in it just to have fun, man, go watch a movie instead. If you're in it because everybody else is doing it, as I said, go do something instead, because this can lead to a great deal of losses. If you see money on the table and things are topping out or things have passed your expectations, it's time to take some or all of it off the table. Okay, you got to monetize your gains. And I think the last one, or one of the most important ones, is you've got to learn to adapt to a changing investing environment. And, 15 years ago, I used to buy stocks on the phone dealing through a broker, paying 1 full percentage point each way. Imagine that. If you had a stockbroker now that charged you 1 percentage point when you enter a trade, and 1 percentage point when you exit it, man, that you wouldn't use that broker. Nobody would use him. You've got online platforms that charge you 0.1% in both directions. Instantly, that's a 90% saving. It's crazy. I would never go through a full service broker again. I don't even think that people even use full service brokers. In the, I can't say the olden days, but again 15, 18 years ago, there was no internet. You couldn't trade currencies like you could now. And with the advent of such technologies, anybody can do their homework and put a little bit of money, and through leverage they can trade currencies profitably. They don't have to make $1,000 a night. They can make 50, $100 a night, and it supplements their income. I mean, things are much better now than they were 15, 20 years ago in terms of trading technologies and investment technologies. The research, it's available online. It's live. You have live PEs. You have live prices. You have live streams of news. Everything is so fast paced, and you've got cell phones that they're mini computers. I mean, you could be walking around and be fed live streams of data or news, whatever. You've got to use those things to help you in your investments. So, as I said, you have to learn to adapt to the times and use technologies to your advantage. So those are the principles of investing. You have to understand all of those before you even embark onto putting your money down on an investment. Now, the first asset class that I would like to talk about is the stock market. And when we look at a stock or a company, we have to understand what stock market investment actually is. When you invest in a stock, you have to understand that you're buying into a company. So you're entering into a partnership with the management into their company. And as a consequence, your shareholding of that company is going to give you a return through either dividends or through capital growth as the company makes more and more money and grows. Plain and simple. And a lot of people don't really invest in companies thinking that they're actually buying just a piece of a company, and they have to look at the management and what the business model is and the long-term outlook is for the company. They just don't care. They just think, I'm just buying something and the next sucker's going to come in and buy it at a higher price than what I paid for it. Again, that's not investing, that's just speculation. And when it comes to stock investments, I've always had one very simple strategy and methodology in thinking about before you put money into that investment. And that is, you have to imagine that you have all the money in the world and you're going to be buying that company outright. You're going to buy all its shares outright and take all its earnings and stick it in your pocket. And if you can adopt that strategy or that mentality before you buy into stocks, you're going to save yourself a lot of headaches when you realize that the companies don't make anything, or their business models aren't sound, or just the whole concept of the whole sector or their technologies is just phony. So if I was to tell you that Coca-Cola was a good investment as a stock, I'm not saying that it is, but this is just an example, then you would say, okay, Coca-Cola, it's worth X amount for the whole amount of shares that's outstanding. I'm going to buy the whole company, and for what I pay for it, I'm going to earn a specific amount of money, whatever it is in billions, and looking at the capital that I've outlaid, is the returns going to warrant the risk of owning the company, and trying to chase those returns. I think the best strategy or methodology of stock picking should be something like Warren Buffett's investment strategies. And when you look at how successful Warren Buffett is, I mean, a guy just picks winners after winners after winners for what, close to 6 decades. You would not find a more successful finder of undervalued companies than this bloke. So whatever this guy uses as his stock picking principles, you should probably listen to or keep them in the back of your mind. And I myself have always known them like that, because they all make sense and they're nice and simple. And when push comes to shove, it doesn't matter if almost all of the principles are followed. If one is not, then it's not a good investment. And Warren Buffett's 4 rules are: a company has to be stable, and it must have a business model that is very easily understood and explained in one sentence. So the company has to be stable, it has to have been around for a while, its earnings are clear and transparent, and the business model is easily explained. So for example, Intel makes computer chips, McDonald's makes hamburgers, Microsoft makes software operating systems, and Facebook is a social networking website that people post pictures and talk crap all day and play games all day long. So, as I said, very easily explained business models. His second principle of investing is that the company must have long-term prospects. These companies must have, through both microeconomic and macroeconomic situations, be viable and be able to grow in the long term, because their business model is sound and they produce goods or services that people want. So fads come and go, but these companies will be here forever. So if you look at Warren Buffett's investment in Coke, people will always drink this stuff. It's just a popular drink, and it has been for a century or so. So it's something that, as the population grows, more people are going to drink it, more marketing, it's got good long-term prospects. Until such times as people find that the active ingredient in Coke causes, I don't know, breast or testicular cancer, and that will be the end of the company. Who knows? His third investment principle is that the company must have good management. So the people that are running the company are good at the job that they're doing, and as a result the company is growing. Plain and simple. You don't want to buy into a company that's been run by a bunch of idiots. And he goes on to say that if the business is that good, then an idiot could one day be running it and still be successful at it. So just something to think about. And the last principle is the most important one, and this is the one that everybody doesn't think about right now, and that is the company has to be undervalued. It sounds simple, but Warren Buffett doesn't buy things when they're overpriced. So when market crashes, he sees opportunities with companies that are becoming cheaper and cheaper by the day, and he puts money into them. Plain and simple. You buy when there's blood on the streets, and you sell when there's euphoria. And right now, all you see is euphoria, and you've been seeing it for 4 years. If you want to look at the valuations of the stock market right now, you just have to look at the investments that Warren Buffett himself is making at this point in time. And I don't think he's purchased anything in the past 12 to 18 months. And if, according to the analysts, things are looking so fair valued or inexpensive on forward PEs, then Warren Buffett, with what, $60 odd billion in cash, should be throwing it out there and buying stuff left, right and center, but he's not. So if this guy, who's the richest investor in the world, is not buying anything, why should the little pawn on the street be doing the opposite? So something to think about right there. But I think we've got to look at now more specific things about stocks, and that are ratios and definitions. So I think first and foremost, and this is not just applicable to stocks but to every other asset class, and this I'm going to talk about later, but the most important ratio to look at is the price to earnings ratio, the PE ratio. Now, price earnings just tells you what earnings you are getting for the price that you're paying for the stock. So it doesn't matter if you look at total earnings divided by the market cap or the total value of the company, or just earnings per share divided by each individual share price. It's exactly the same. Now, PEs, there's two types. There's trailing PEs, which just means the last 12 months earnings divided by the current share price. That to me is the only thing that I look at. Because the other ratio, which is the forward PE, so what the guidance of either the company or analysts or economists are giving about the company or the sector, whatever it is, things can change. So you purchasing an asset on the promise that the company is going to grow X amount next year is a dangerous game. Especially when basically all the markets are being manipulated by the Federal Reserve through keeping interest rates low. But that's not a topic of this discussion. So price earnings should be your most important consideration, nominal consideration, before you make an investment. And as I said before, it's not just talking about stocks. The second ratio that I want to talk about is the price to sales ratio. And this is probably just an important a ratio as it is for the price earnings. Price to sales ratio just tells you what price you're paying for every dollar of sales that the company makes. So you're only looking at the top line revenue of the company. And the advantage of looking at the price to sales ratios is that sales is one thing that you can't really fudge, unless of course you're Enron. In that case, anything goes. But with PEs, you can be you could be put into a false sense of security through accounting magic. So they can look at the balance sheet and take things out or add things in, and you can always trim your fat by laying off staff and whatever. But whatever accounting fluff that's done can affect your PE, because all the PE looks at is the bottom line. And that's what the E is in the earnings. It's the net profit. But with price to sale ratios, sales are just sales. You can't really fudge them. So they can give you a better idea as to how the company is growing or how the company is worth in relation to either the whole sector or to the overall index or the industry, when you compare its ratio to others within the group. Another important thing to look at when you deal with stocks is debt. Company has a lot of debt and it's not making productive use of that debt, or it incurred a lot of debt as a result of trying to grow and purchase another company. So take a look at Verizon in the past week or so. It could spell a lot of issues, and a lot of red flags should be raised as this debt mounts. And another measure of a company's value or its efficiency as a company is to look at the return on equity. I've made videos on this before, and quite simply, the return on equity is just how a company makes a profit out of the money that it raises through its IPO or whatever, or any input into the company. So if you look at a return on equity of a company, two companies that have raised $1 billion in capital, and a company A makes 100 million in its first year, and company B makes 50 million. Now they've both used $1 billion of capital, and one has made 50 million and the other one's made 100 million. So the company with a higher return on equity would be the company that made the 100 million on the billion. In fact, it's got the double the return on equity ratio as the other company, which means that it makes a better return on its capital. Company A makes a better return on its capital than company B. Sometimes this is not so important, but it's worthwhile looking at when you're trying to work out which company is more efficient in terms of making profit using the money that it has, or the capital that it has. And finally, I think that the last thing that you always have to remember with stock ownership are dividends. And dividends are simply the distribution of the company's profits to its shareholders. Plain and simple. Now there's taxation implications and franking credits in Australia and all these funny things, but that's not our topic of discussion. With dividends, I only have one principle that's attached to them, and that is the dividend is what the company pays you whilst you're waiting for the share price to go up. So if you buy a share that pays 5% dividend yield a year, then you're being paid to wait for the capital to grow, for the company to grow. Companies that don't pay dividends don't pay you to wait, so waiting could be a very costly exercise because there's opportunity costs. But that's a subject of another video. So after discussing all these terminology and all these fundamentals of stock ownership, what's the relevance of all that in relation to the current stock market situations around the globe? Well, I'm not going to talk about every stock market. I'm just going to talk about the US and somewhat a little bit about the Australian market. The first things first, I'm just looking at a Bloomberg terminal, and you've got the S&P 500 trading at a PE of just shy of 19. You've got the Dow Industrial Average with a PE of just over 17. The Nasdaq's PE is about just shy of 21. And the Russell 2000, which we're not going to be looking at, is trading around 82. Now, as I say, PEs are a good measure, but PEs aren't a very good measure of companies, or of the value of companies that have either no earnings, that they've just started up, or they've just had, through bad luck or bad exogenous circumstances, have a loss. So we've got to use the other measures, fundamental measures of value, to try and work out whether a company is undervalued or overvalued. In general, you have to treat PEs as how long it would take you to get all your money back, plain and simple, through its earnings. So if you look at an investment into company XYZ and it's cost you $100 million, and it's trading at a current PE of 10, and provided that all things remain constant, it means that it would take you 10 years to get all your money back through its earnings had you bought the whole company outright. 10 years seems a fair deal. I mean, it's better than the rate of inflation. So PE would seem to be quite cheap. Now, I'm not talking about personal business, because I know for a fact that through the acquisition of personal businesses, PEs of 10 are even too big. I mean, my first business I bought for $500,000, and it had earnings of about 110 grand. So the price earnings was about 5, and even that was deemed to be a bit too high for the banks. So I had to get the wholesalers to give me a guarantee on the loan. But anyway, that's a different story. So 10 is on the cusp of inexpensive when it comes to publicly traded companies. When the P's get up to say 15, and they say that 15 is fairly valued, it means that it's going to take you 15 years to get your money back, and that's getting a bit long in the tooth. Now when you get to the high teens or even the 20s, 20 years is just too long. And 20 is actually a high number, especially in today's market, simply because inflation is running at, I'm just going to use a number that's out there, just judging by the increase in gasoline or petrol prices. Let's take inflation to be 5%. So if your PE is at 20, it takes you 20 years to make your money back. You've violated one of the principles of investing. And the principles of investing says that you put money into an asset class that's going to give you a greater rate of return, either through income or capital growth, greater than inflation. So if inflation is at 5% and the PE is at 20, you've broken even with the real world out there. I mean, in nominal terms, yes, you've made 20 times. You've made all your money back in 20 years, but in terms of spending power, you're back to square one. You might as well have taken your money and just kept it in the bank, because for all the hard work it's taken you to manage the company, you've broken even with inflation. That's crazy. Just put your money in gold and be done with it. Plain and simple. So if you're looking at the S&P today trading at 19 times, it's an overheated market. And if you want to know when the last time the S&P traded near 19 times was, you probably guessed it, just before the GFC. And before that was in tech wreck in 2000. So we are nearing valuations, and I'm talking trailing PEs, of 20. Okay, it's 19, but 20, it's close enough to 19. So if you were to look at your principles of investing, purchasing stocks at a PE ratio of 20 on a trailing PE is nonsense. It violates everything that I've just said. But the analysts are painting a very different picture. And the economists and the hedge fund managers and the bankers, whoever's that are out there, they're just a big bunch of dopey lemmings who just can see a trend, and the trend is up. But don't forget, the trend was up in tech wreck, and the trend was up in the housing market in 2006. So as I said, just because everybody is saying that it's good doesn't mean that it is. A lot of what these lemmings are saying is that the stock market is either fairly valued on a trailing basis, which is an absolute of bull dust. But they say that the market looks cheap based on forward guidance, because they're now pricing the S&P 500 right now on a forward PE of 15.5. And as I told you before, 15.5, they say it's fairly valued, but to me it still doesn't look fairly valued to me. It looks expensive. But that's based on everything going right. No crisis ahead. Interest rates at 0 to infinity. Governments keep on printing. Government keeping on spending. Well, this is the subject of another video, but let's just say it's not going to happen and fundamentals are going to catch up. Fundamentals caught up with rising stock prices in 2000, and fundamentals are going to have caught up with the housing market in 2006, as well as the stock market bubble that occurred at the same time. And this time, it's exactly the same thing. Stock markets are overpriced. It doesn't matter where you are around the globe, but more specifically in the US, they're at all-time highs. And I can tell you that fundamentals are out the window, because people aren't even looking at what companies are doing or earning. All they're concerned about is the macro side of the equation, and that is basically what the Fed's doing. And the Fed has put a floor beneath stock prices and are holding stock prices up by artificially keeping interest rates low. That's the subject of another video. So if you look at companies out there, and I'm just gonna, I've picked 3 or 4 just to illustrate how much nonsense there is going around the place. The first one is Netflix, and it's not because it's one of my favorites to bag, it's because none of these companies' business plans or models make any sense. Its earnings are just abysmal, but yet the price is at an all-time high. And me picking this stock is also of great relevance because it's the #1 performer of the S&P 500. That's got to be telling you something about the S&P 500. Now, Netflix is just a movie streaming business and a DVD hire, a mail order company for hire. Very simple business plan, but it's got huge costs. It has to pay huge licensing fees for the movies that it has to buy the rights to so that it can actually stream it out. The costs are so huge, and the overheads are so huge that regardless of how much money that it pulls in, which is questionable by the way, I'm not saying that it's fudging it, but how long they can keep it up in an economy that's getting more and more broke, that's what's questionable. So you've got a company is pulling in billions, but is spending out billions to give you a net result of last year. It made, what was it, $18 million. This thing is priced at $300 a share for what, 59 million shares or something like that, and it has a market capitalization just shy of 18 billion. Now, if you had 18 billion and you put it in a company, and you knew that this thing was making you 18 million, would you bother? Again, can you see any violations of the principles of investing? I mean, this thing right now on the Bloomberg terminal has a trailing PE of 227. I have on another screen on the cnnmoney.com website that actually gives the trailing PE of Netflix at 376. I don't care if it's 227 or 376. Who cares? It's nonsensical. Putting money into this stock is going to end up in tears. You're going to end up buying a lot of tissues. You're going to have to wipe a lot of tears, because this thing is not, first of all, the company is not that viable, and secondly, just the valuations are astronomical. This valuation is greater than most of the other tech rec companies during 99-2000. And you know what's happening? People are piling into it. This stock went from 52 earlier this year to now 300. It's all momentum, it's all technicals. And a whole big bunch of lemmings just piling in onto this gravy train, thinking that there's going to be a greater fool out there that's going to pay even more than what they did. Throw away the fundamentals, let's speculate. So if you want to put money in Netflix, you're speculating. And I've only just pointed out one of the contradictions of the principles of investing by looking at PEs. If you look at price to sales, it's just as abysmal. If you look at the book value, I haven't spoken about it, but things like the tangible assets to the company, there isn't any. There is no fundamental measure of value that anyone with half a brain that you can use to sensibly put a tick next to the stock when it comes to you putting money into it. There's none. So enough of Netflix. It's a bomber. The next company I like to look at is Facebook. And yes, the two companies were technology companies, but they're of great relevance because they're illustrating the frenzy that's going on at the moment. Facebook debuted last May. There was a whole glitch about the IPO and so forth, but who cares about that? They IPO'd at $38. They valued the company at $100 billion. Most people thought, oh man, this company's got 1 billion users, of which half of them are fraudulent anyway. The audience is huge. It can do anything. Very soon it's going to probably have 10 billion users, despite only there being 7 billion people on the planet, and a whole bunch of stuff can be created by the company. It's meant to be one of the leaders of industry, of the new technological age, of the social age. I don't care. I like to look at fundamentals, and again, the principles of investing. So if you were to look at Facebook, you look at, first of all, the business model. And as I mentioned before, what is Facebook? Facebook is not a company that produces anything. No, it doesn't provide anything. All it does is, it does provide something. It provides a social platform through which people talk crap to each other all day long, post random postings about everyday nothingness, post pictures that are just totally irrelevant to most productive means or most productive uses that are out there, and finally to play games. So if you were to think of Facebook as a company that has great industrial capacity or a means of providing a lot of services that are going to benefit the economy, you're wrong. Facebook is actually counterproductive. When you play a game on Facebook, you're wasting time that you could be spending elsewhere doing something more productive, or even sleeping for that matter. But that's just the fundamental side. Let's look at the earnings side. Let's look at the balance, the ratios that we've been talking about before. Price earnings of Facebook is, bear with me, the current PE ratio of Facebook, according to Bloomberg Terminal, is 191. The forward PE is expected to be 61. I don't care which metrics of value you choose, or what methodology you have in picking stocks. A P ratio that is that high, whether it be trailing or forward, is asking for disaster. All this company does is sell ads, and those ads are just on a platform that I told you is just a counterproductive waste of time to the economy. The reason why I picked this stock to talk about is because it traded below its issue price for over a year, and only recently did it pass it. And now at the current stock price, what's that, 43, 49, 41, you're looking at a price that's about 16% higher than its issue price. So after about a year and a bit, a year and a half almost, it's now up 15%. But is the company really making money productively, or is it making really good productive use of its capital? It's not. It's buying out other useless companies like Instagram and all these little not search engines, but just these little social platforms or enhancements or picture taking enhancements or uploading enhancements, whatever it is. The company is not a company that I would put money in, simply because its business model is flawed, and the macroeconomic situation right now is favorable for it, because the American economy is coasting on stimulus, and there's a lot of cheap money flowing around, and people don't really have to work because most people are out of work anyway, so they can have plenty of time to play games on Facebook and talk crap all day on it. But what happens when the next crisis hits? Do you really think that people who have got no money to spend and are starving are going to be turning to Facebook for help? Hell no. So all these companies with phony business models, or so I shouldn't say phony, but just flawed business models, are destined to go down. They're basically fads. And you can remember in TechRec how Yahoo reached astronomical valuations and people were going to bid it up even further. And Jerry Yang, one of the creators of it, was multi-billionaire. He still is right now, but he's a lot poorer for not having sold off his entire stake. So Facebook right now, it's made a bunch of angel investors and its founder and a couple of initial investors quite rich, but it's paper wealth. And if they've cashed out, good on them. If they haven't, well, time will tell. And again, with the beginning of this topic of discussion, fundamentals will catch up. So, as I said, Facebook, Netflix, flush them down the toilet. Another one that is of relevance, I think, is Apple. Now, Apple last year, in September, exactly this time last year, reached an all-time high. Market cap exceeded $600 billion. It was the largest company ever. And everything that it touched turned to gold. Everything that it made, people were queuing up outside stores for a week, and through wind, hail, sun or shine, whatever it was, they were chasing the products, and Apple could not set a foot wrong. Well, within 6 months of reaching an all-time high, its share price fell about 40%. And I think Apple is a known victim of its own success, because its its main moneymaker is the iPhone. And when everybody on the globe that can afford one, that wants one, has one, where's your future avenue for growth going to come from? We all know that Apple Macs, well, when I went into a computer shop, the Apple Mac's major selling point was the fact that there were no viruses on it. People don't write viruses on the Apple Macs simply because there aren't any of them going around that people even bother. Well, if that's your selling point, sorry man, that's not good enough. Because all Apple products, as you know, are overpriced. So if you own an iPhone 4S or an iPhone 5, and they just came out last week with the new iPhone 5S or C or whatever, and the difference between that phone and your phone is a fingerprint scanner, who cares? Or the fact that it's made in a different color, is that gonna spur you on to spend $500, $600, $700 to buy a plastic colored phone that's basically the same as yours that you only bought last year? I don't think so. To sell a product, you gotta innovate. You gotta make the product better. Just adding a fingerprint scanner on a phone is not going to make it more attractive so that somebody's going to give up their old phone and buy a new one. But the thing about Apple is that it's trading at Apple, where's the P? Hang on a second. Market cap. The P ratio of Apple is only about 11 according to Bloomberg. So, technically speaking, it's pretty good value. But the only thing that I question are the forward estimates. So, at today's price of $472, if it's trading at 11.8 or something along those lines, it may be a good investment for now. But if Samsung keeps on surging and producing better phones and Apple is not keeping up, and your iPhone is more than half of your company's earnings, well, there's going to be big questions asked of Apple as a company by its shareholders. And so, despite a company being so large, and in fact, Apple is 20% of the Nasdaq 100 in terms of weighting, well, who knows? In a declining economy, who's going to be willing to renew or swap over their iPhones for a new one and fork out, $500-$600 for these plastic phones? So even with large cap, what seems to be undervalued companies or fairly valued companies, the growth outlook is questionable. Simply because, again, we're looking at fundamentals. Now, the US stock market is totally driven by the Fed. And I've said this in this video or the previous ones. So when the Fed is found out that it has no credibility and what it's doing is just totally inconceivably stupid, and it's gone to a stage where there is no exit, there is no method of escape, there is no magic pill for the next crisis, all these company valuations, they're just going to get crushed. I even question the naming of the Dow Industrials. I mean, of the 30 Dow companies, and 3 of which are about to be replaced so as to make the Dow bigger, because it's a dollar weighted, it's a price weighted average. They're replacing all the small price stocks with big price stocks, so the average is going to look much bigger at the end of this month. It's called the Dow 30 Industrials, but how many of them are actually industrial companies? How many of them actually produce anything? And I counted up, and there was 12. And I even counted McDonald's as a company that produced something, in that it was hamburgers. But that we all know is not really producing anything. So that's a question for debate for another day. So you've got analysts, economists, commentators all these lemmings are jumping in and talking about stocks being fairly priced at the moment because they can't look at a camera and keep a straight face and say that they're cheap when they're obviously expensive. So the best they can come up with is fairly priced at trailing PE level, but they look attractive when you look at the forward estimates, so the forward PEs. But again, as I say, you know, when people talk up the future, you know that the end game is not too far away. And right now you're hearing the same rhetoric, the same commentary in this stock market as you did in tech rec. And that's what I find is scary. And that's why I stopped watching financial TV, because I keep on hearing the same rubbish day in, day out. Stocks are cheap, you should get in now, they're only going to get higher, 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 higher. I've actually seen one guy actually say P's don't matter because there's a huge growth environment. It's a huge growth environment, so you've got a lot of multiple expansion. You want to talk about multiple expansions when a PE is at 200 or 300 or 376 for Netflix? God, man, you're a brave soul. But as I said, when you look at the stock market, it's not really priced at a level where you should feel comfortable getting in, especially when it's at all-time highs and the economic outlook is actually bleak. This is the subject of another video. And on the subject of stocks and holding on to stocks and the opportunity costs or the costs of owning stocks, or you've got to look at dividends. And dividends are what pay you to wait whilst holding on to the stock. Now you've got an S&P 500 yield of 2.1%, a Dow yield of 2.4%, and a Nasdaq yield of 1.5%. I'm telling you now, inflation is roughly about 5%. Just a number that's out there. So if you're chasing those yields, thinking that they're compensating for inflation, forget it. Take your money, flush it down the toilet. It's the same thing. So dividends are not attractive enough to warrant you purchasing a stock, even just to get that yield, because inflation is much greater than that. And the analysts are out there beating their chests and talking up these fantastic yields because they're higher than treasuries. Treasury yields are manipulated. So obviously these yields are low because the stock prices are so high. So you're going to chase a yield of 2.4% by purchasing a stock that's trading at 20 times earnings? That's crazy. That's every fundamental principle of investing has been violated in what I just said. So stock markets are not a good investment, especially in the States. But let's move closer to home. And I like to look at, say, the ASX 200, our local stock market. You've got BHP, our biggest company, whose earnings outlook is questionable, despite Chinese PMI data earlier this month being positive for the second month in a row, and they've reached bottom, whatever. We all know that fudge numbers is one thing, but the economic outlook in the States is bleak at best. So what's going to happen to China? What's going to happen to its demand for resources? That's where BHP is going to fall over. And its Achilles heel is that it's a proxy to China, and therefore it's a proxy to the demand coming from the US and Europe. Well, we all know about the demand from Europe, and we all know about demand from the US. So let's see how long BHP can be held up for. And I like to remind people that BHP came from 7 in 2001. $7. It went to 50. It's now what, 35. It's got a long way to go. Long way to go. Downwards, that is. But I could be wrong. The Fed could be able to manipulate rates for a long time, and the whole world could turn a blind eye to it, and a lot of people a lot of people have lost and are losing and will continue to lose their money's purchasing power because inflation is being exported all over the planet. But we'll see how long this game lasts. And as I said, that's the subject of another video. Another sector I'd like to look at, it's not just BHP, it's Rio, Fortescue. All these resource companies, they're just overpriced. Even though they've come right off their highs, they're overpriced. But another sector which is actually at an all-time high are the Australian banks. And the Australian banks are going to fail. The Australian banks, the majority of their income is through mortgages and personal loans and credit card loans. What's the driver of an economy? It's a small and medium-sized business. So what's business lending like at the moment? It's declining. What's the employment situation in Australia? It's the unemployment rate is going up, so therefore employment's going down. The labour participation rate in this country has reached levels from the early 70s. So 65% of the adult population is working. The people that can work are working. 65%. It's because a lot of people have just given up looking for work, or there's just some people are just too disabled or declare themselves disabled, and it's easier to collect a pension than going out there looking for non-existent jobs. I can tell one thing's for sure. There are a lot more shop closures in this country than I've seen in a long time. Even during the GFC, I haven't seen so many shop closures. So that's to tell you something. If you've been around just 3-4 years ago, I reckon everywhere you walked, there was body shops everywhere. They're the people who make nice smelling soaps and a lot of overpriced shampoos and creams and all that fluff. Now, I think there's only about 10 stores in the whole of the state of New South Wales. And there used to be on every shopping centre, every street corner, there was one. But the economy is not allowing people to splurge on such extravagant items. So they're disappearing. There are a lot of shops are just closing down. It's just the economy. So if the banks aren't making loans to the driver of the economy, so that is small business, whether it be in retail or manufacturing, it's telling you that the economy is going backwards. And I made an update recently about the GDP growth in relation to inflation, and just looking at government numbers, trusting government numbers, we've got no real growth in the GDP. And our budget deficit has ballooned from 1 billion to 33 billion in the space of 3 months. So government revenues are shrinking, small businesses are closing down or are not borrowing, they're not growing, and the only thing that's keeping the banks afloat is the issuance of more mortgages and more credit card debt. And we all know that real estate is overpriced, but that's the subject of the next asset class. And when things turn around and a lot of these real estate assets go backwards, you're going to find that the banks are going to lose a lot of money on their books, and the cash flows that they have will actually turn negative, and the end game will ultimately come when interest rates go up. So the banks are sitting, everybody is beating the drums of the bank. Everybody is saying that they're fairly valued or they're cheap, you should go in, they have a yield of 6-7%, but that's not the point. The banks are only able to do this whilst interest rates are low, and as long as the government can lie about inflation. So if you own the Combank, Westpac, ANZ, any of that rubbish, and especially if you've got considerations to buy into them now, I'd like you to think twice. do your math and trying to work out where these things are going. I mean, the sector PE is almost 20, and this is as bad as it gets. So you have to look at fundamentals, and you have to look at the earnings, and that's what I want people to think about when they look at stock market investments. So regardless of how much happy chatter there is out there, the stock market is overpriced. And just because everybody is still buying and everybody's jumping on the bandwagon doesn't mean that you should too. So that stock's covered. I'd like to take a look at actually the biggest bubble of them all. Now, that's the second asset class. That's fixed income, bonds. Bonds, by definition, is just an IOU issued by either the private sector or the public sector. So companies that want to raise debt to fund productive acquisitions or expand their current business issue these bonds with a certain yield, hopefully higher than inflation, and people are willing to lend them the money by acquiring these bonds, being paid the interest, and when the bond matures and the company has made back the money that it's borrowed, hopefully it'll give it back to the individual. The public sector or the government issues bonds because it just has to pay for things that its revenues have come short by. So if the government aren't raising enough revenues through taxes, but it has to pay out a lot out in terms of social infrastructure, social costs, the welfare, defense, and a whole bunch of other stuff, it has to make up that shortfall by issuing these treasuries, these bonds. And when it comes to bonds, you've got different lengths of time that you can invest in. You've got short-term bonds, you've got intermediate bonds, and you've got long-term bonds. So you've got things from 30 days, 1 month, 2 months, 3 months, 6 months, 1 year, 2 year, 3 year, 5, 7, 10, 15, 20, 30-year bonds. And that goes across the public. The actual length of all those maturities is more towards things like treasuries, but even the corporate sector has got short-term bonds that are 1 year, and they can go all through to the 30-year mark. But the most important thing when you look at bonds is that you invest in bonds because you're actually scared of risk. You believe that the ratings agencies have done a good job in rating the debt that you're about to buy or the money that you're about to lend the issuer of these bonds, and the issuer's ability to pay you back is very important. And this is where the American government's going to get unstuck in the very near future. The whole point of buying a bond and you doing your research and your homework is that you have to believe that that entity that you've just loaned money to is able to actually pay you back. And once you realize that it cannot pay you back, or the ability to pay you back, or even service the loan by giving you the interest payment on the debt, you're going to dump it. Plain and simple. So right now, what's wrong with the stock market, with the bond market? Well, it's in its biggest bubble of all time. It's been deflated somewhat in the past 6 months since the talk of tapering. But let me tell you, there won't be tapering. And in fact, they're going to be expanding these purchases, but that's a subject of another day. The Fed is manipulating interest rates. And it does that by keeping its Fed's funds rate, so the amount that it lends to the big banks, at close to naught. And it price fixes the interest rates on the government's debt by purchasing government bonds. So it prints money to buy these bonds and therefore lends the money to the government, basically to squander. So the Fed is distorting the entire bond market. It's not just treasuries, because people who used to invest in treasuries are looking at yields of, well, 6 months ago, 1.6% on a 10-year. And I just told you inflation's at least 5%. Who the hell's going to invest in something that's going to return 1.6% when inflation's at 5%? But people are still doing that because they believe that they buying something that the Fed's going to buy off them at a higher price than what they paid for it. And what is that? That's speculation. So I don't see the point of putting any money down in the sovereign space, especially in the American Treasury space, because the whole thing's a Ponzi scheme. The whole thing works by issuing more bonds to suckers, to pay off suckers that loaned them money in the first place. They can't even the American government couldn't even service their debt if they tried. They just cannot. That's why the budget deficits, although they've come down to the lowest since the start of the GFC to $770 billion or something, from a high of 1.6 trillion. I mean, these numbers are astronomical. The previous administration had budget deficits of 350 billion. So even right now you're looking at these huge deficits. And when interest rates have to rise because the market dictates them to rise, the American government's just going to default because it can't service its debt. It can't even forget paying back its debt. It can't even service its debt. Period. So if a government cannot service its debt or cannot repay its debt, and you've worked out that the whole thing is a house of cards, a Ponzi scheme, that the treasuries that you bought are about as valuable as toilet paper, well, you've only got yourself to blame because you were speculating. It's not an investment when your rate of return is smaller than inflation. You violated the first principle of investing. And if you want to look at PEs, even at current rates of near 3%, I'm just going to use 3% on a 10-year. 3% means it's going to take you 33 years to get your money back. Although it's a 10-year, I'm just talking about PEs in general. You're looking at it 33 times. Now, if 15 times is what's deemed to be, average, fair price, slightly expensive, 20 times is expensive, what does 30 times and 33 times mean to you? 33 times is so out of proportion, you wouldn't even touch it with a 10-foot pole. The whole bond market is rigged. The Fed's doing the job on the treasuries, but what's happening as a result of them buying treasuries and mortgage-backed assets is that they keep the yields down on those, so that people now are leaving the government bond market and going into the private sector, the corporate debt. And corporate debt, even what used to be called junk bonds, are trading where the AAA rated sovereign treasuries were trading at 5 years ago. So junk bonds, which should be rated F for fail, for miserable fail, these companies could go under at any moment, can issue debt at 3 or 4%. So you're taking all the risk of a company going under and not paying you anything back to try and get 3 or 4% when inflation is 5%. If you can explain that to me in such a way that I can say, yes, I will put money in it, feel free to do so, because it's not comprehensible by any sort of mentality or methodology for investing that you have. And I think the one thing that a lot of people are violating investment principles when buying bonds, especially US Treasuries, is that bonds, or the names of fixed income, are purchased for exactly income. They're not really there for capital appreciation. That's not the name of the game. But right now, people are piling in on the expectation that the Fed's going to buy the toilet paper that they have at an even higher price than what they paid for it. And that is buying bonds for capital gains, because it certainly won't be for the yield. And that's speculation. And again, speculators are going to get killed. You've got companies that are issuing debt or bonds at a record pace. Apple Corporation 6 months ago issued $17 billion US of Apple bonds. They were yielding 2%. Just told you, inflation's at 5%. Apple has $125 billion of cash in its books. That's cash. This company is rich enough to buy out entire countries. But it decided to issue the largest bond issuance at that time of $17 billion. And why did Apple do that? Why would it need to raise $17 billion when it's got $125 billion in the bank and it's going up by the day because suckers buy their product? That's telling you that even the people who run Apple aren't that stupid. They realize that if you issue debt now, you're getting paid to issue debt. You're not even paying interest on the debt because they know that inflation's at 5 or 10%. So if they can put money out at 2%, they're actually making money on their real money on their money, on these loans. Who wouldn't do that? And secondly, I think the mentality behind issuing all that debt is that they know that eventually the currency is going to fall to crap, and therefore whatever loans that you have are going to be meaningless. So I think that taking out that 17 billion is more as a hedge for the 125 billion. But that's just an afterthought. I'm going to look at Verizon. Just at the end of last week, Verizon in a takeover of Vodafone's wireless, some crap. Look, phone companies are just utilities. They're just like things that people use. Water, power, phones are not the same thing. They're not being innovative. All that people use phones for are like Facebooking each other, just counterproductive game playing and just talking crap all day. Internet, look at rude pictures or upload pictures, whatever it is. Phone companies are just saturated. The market is saturated, and the prospects for growth are very slim because there's just no new technologies. There's no innovation. So what Verizon did was it bought over Vodafone's wireless unit for 130 billion, something like that, cash and bond and script, whatever it was. They issued $49 billion worth of debt. And these range from the short term yielding 4.5% to the long term about 6.55%. Why would you lend money to a company that is facing no growth prospects? It's actually facing negative growth. And the returns you're getting is barely above that of inflation. Why take on that risk? And this is what the third largest takeover in history, all funded through debt. And you want to buy that debt? That's crazy. I can't see people making money out of this or getting an income out of this, because all they're doing is losing the purchasing power of their money whilst the Fed's printing pedal to the metal. And they think that they're getting, 3-4%, but inflation is much higher than that. And you've got people who invest in bonds at a record pace, and people are just chasing yield. And this chase for yield is driving bond prices even higher. I'm talking both corporate and government yield. And this is just blowing up this huge bubble. This essentially with Treasury, it's a government debt bubble. And this is going to have disastrous consequences because the size of the debt is so big. And $17 trillion is such an astronomical number that it actually dwarfs the numbers that I deal with when I look at astronomical distances, things like light years. The American debt is larger than a light year in terms of kilometers. This number is so big, and the ability to service it at 0% is already putting strain on the government's balance sheet. They have to print more money just to service the debt, and they have to, by printing money and by borrowing money to service the debt, means that the whole thing's a Ponzi scheme. Just think about this in your own time. But ultimately, with all these bonds, and especially the largest holders of these bonds, I'm not talking about the Fed, but I'm talking about the banks, especially the US banks. The US banks they're borrowing Fed's funds rates at close to 0%. They're purchasing bonds which are yielding, now 3%. And the spread between the two is where all their income is drawn out from. So they could be making billions out of that 280 basis point spread. So the banks are lending money to the government with money from the Fed. Now, when interest rates go up, when inflation dictates that rates have to go up, all these banks, so the bondholders of the banks, the shareholders of the banks, the depositors, all of them going to be extinct overnight. They're all going to get crushed. And they're all going to be insolvent because they find that the treasuries that they own are worthless. Again, toilet paper. But I actually have to apologize to actual toilet paper makers because they actually don't want their product associated with American treasuries. They take offense at that, so I'm sorry about that. The downside to all these bonds is inflation, and it doesn't matter which way you look at it. There's a lot of inflation out there, and the length of time that the American government can issue these bonds to sucker speculators out there, the time that it can do that is dictated by the willingness of countries to accept these bonds as payment for the goods and services that they ship over to the States. When they find that because they've imported a lot of this toilet paper and inflation for the goods that they've sent over, and they find out that the inflation that they've brought over is much higher than the rate of return on this toilet paper, they're going to dump this paper and they're going to refuse this toilet paper. Sorry, I have to stop using the word. These treasuries, they're just going to dump them, and there's going to be, first things first, a treasury crisis and basically a currency crisis, because a bond is an IOU denominated in a US treasury is a bond denominated in US dollars. So the more the government prints, the more the currency gets devalued, and subsequently when people dump them, the currency is gonna precipitously fall. But that's a subject of another discussion. So the bond market, there's no investment principle that is followed by anybody who puts money into that market, whether it be corporate or public. Plain and simple. And the last thing that I want to do, the last asset class that's worthy of a mention, is the real estate market. And as you all know, there's two types of real estate that one acquires. It's either residential or commercial. Residential, you live in. Commercial, you rent out to businesses and manufacturers, whatever. And people buy real estate for two reasons. Either, as I said before, to live in or to rent out. And most important of all, the fundamental value of a house or a commercial property should be dictated by the market rent. So stock prices are a function of earnings. Bond prices are a function of the yields. And real estate prices should be a function of rent, plain and simple. And if you look at what happened in the States, and house prices escalated, 60-80% in some areas in the space of 4 or 5 years. I'm going to talk about the Australian housing market because I'm not too familiar with the housing market in the States or the localities, but I can more relate to the huge housing bubble that's within our own country. Now, I'm just going to use Sydney as an example. House prices in Sydney have more than doubled in the past 10 years or 12 years. More than doubled. I think it's about 117% or something along those lines. We're talking about the median house price. The median house price stands today at $620,000, and the median unit price in Sydney is about $460,000. Now, it doesn't matter what the median house price is or the median unit price is. More importantly, you have to look at what the returns on those things are. And when I talk about returns, it's not about your principal place of residence, because people have to live somewhere, so therefore where they live, it's not going to give them a rate of return. You're essentially, in obtaining a mortgage from the bank, you're paying the bank rent. That's all it is. To really look at returns, you've got to look at rental properties, whether it be residential or commercial. And I'm not going to dwell on it too much, but you've got Sydney Sydney average house yields, rental yields of 4.3%, and you've got Sydney unit rental yields of 5%. So even before I talk about the acquisition costs of a rental property, the returns on a house, its nominal rate of return is 4.3%, but its real rate of return, given that inflation is 5%, is actually going to be negative. Again, you're losing to inflation. So is there any point in investing in a house to rent out when you're actually losing money to inflation during this process? A unit, it's about the same. Our government put inflation at 2.6%, 2.4%, whatever it is, it's a lot of baloney. Look at petrol prices, inflation is not 2.4%, but that's a subject of another day. So if you were to buy a house or a unit, your expenditure, the stamp duty on a house or a unit is like 4%. So your entire first year's rent has been paid out in stamp duty. So you pay this tax to buy the property in the first place. So your costs are astronomical. I'm not even talking about the upkeep, the maintenance of the property, the repairs, the rates you got to pay, the conveyancing when you purchase the property. This is even before that. Just your biggest expense, the stamp duty, is equivalent to your whole year's first rent. So you're a big loser if you're buying a rental property. Now, when you're looking to buy a house to live in for a couple of years and then flip and sell off with the expectation that an even dumber sucker is going to pay you more for it, well, I don't think you're going to make much out of it, because the stamp duty has already eaten 4%. And house prices aren't appreciating at 5% a year. So if you hold it for 2 years, all that effort is probably going to cost you money in terms of real money. and adjusted for inflation, you're going to lose money by trying to flip a house. And I even question home ownership, because if the rate of inflation is about 5%, and the rental yields on a house in Sydney is about 4.3%, then technically you're actually being paid to rent a house. So why wouldn't you do it? You don't have any of the headaches of a mortgage, the shackles of a mortgage. You actually don't have the headaches of maintenance. You actually don't have the headaches of rates. You actually don't have the headaches of a lot of problems with repairs and insurance and all this fluff that's out there with these costs associated with home ownership. You can forego that, pay rent, which is less than the rate of real inflation, and you get to live in it basically for free. You're being paid to live in it. Why wouldn't you rent? It's crazy. So I've been reading a lot recently how a lot of foreign buyers, especially Chinese, are coming in with suitcases full of cash and paying cash for Australian properties. You know, good luck to them. Right? But the Japanese did the same thing in the 80s, that they bought huge sections of the Gold Coast and whatever, and at the end what happened? They just sold it all because they realized that it was overpriced. The same thing's happening now. People don't realize that the housing market is very frothy, and it has been for many years, despite the recent bleep we've had 3-4 years ago with the GFC. It doesn't matter. Sydney prices are way overpriced when you take rent into account. And I think that ultimately there's one concept that a lot of people don't think about when they purchase real estate or anything for that matter, and that is, what is the value of something that you've just bought? What is the actual price? The dollar value of an asset or anything that you've just purchased actually is, without looking at what you paid for it. And the answer is, it's what the next sucker is willing to pay for it. So just because you've bought a glass for $5 doesn't mean that that glass is worth $5. It's only worth as much as what the next person is willing to pay for it. So therefore, if you buy a house for $500,000, it's not really saying that the house is worth $500,000. It's only saying that you were dumb enough to pay $500,000 for it. Because if there's no buyers, your house is worth nothing. Because if there's no buyers, there's no market. And this is true for bond markets, stock markets, every markets that there are out there. If you buy something, its intrinsic value may be there, but its market value is only dictated by what the next person is willing to pay for it. So buy something for $5, there's only one buy out there for $1, that glass is worth $1. And Sydney house prices are going to feel the pinch when the economy goes into reverse and interest rates have to go up because inflation is going to start flaring up, and the government statistical officers can't lie about inflation numbers anymore. And if you find that house prices right now, although they're very, very high, they're not rising or escalating at a rate that was comparable to the US. It's just that our real estate price rise has occurred over a much longer period of time, but the actual nominal figures are much greater than any of the house price appreciation that's been experienced in the States. Now you're talking about 117% appreciation over 12 years compared to an inflation rate, government numbers, of about 29% over the same time period. So house price appreciation should match the CPI somewhat, and it hasn't. It's actually outpaced it by, what's that, 80 odd percent or almost 90% odd in the past 12 years. So something's got to give, because if you want to tie house price appreciation to CPI, you can also attach house price to wage growth, which in itself should be theoretically attached to CPI. So if you have people whose wages aren't growing, but the houses just keep on appreciating in value, what's going to give? What's going to give? Is it that the person's going to get suddenly a huge wage rise of 100% to compensate for the house prices having gone up 100%? Or house prices have to come down because fundamentals catch up with this asset class? And the answer is fundamentals will always win out. And this is a very important concept which a lot of real estate investors are not thinking about when they're putting down money on purchasing these properties, is that they believe that this market can only go up forever and ever and ever, and it's only blue sky potential. Well, that's what people believed during the housing market bubble of 2006 over in the States. They believed in places like LA, where residential house prices could escalate at 20% a year, every year until the day they die. And it's the same fallacy that's going to cause a lot of people to lose a lot of money in this country, and the banks are going to lose a lot of capital based on this. They may or may not fail because there's a government guarantee, but the government guarantee might not be there if the government's broke, judging from the expansion of the budget deficits. Don't forget, Australia's is a proxy to China. If China stops buying our resources, that's the end of it. So, as I said before, we've got a housing market which has gone up so much, but yet at this point in time it's not really climbing too much, or it's not climbing at all. It's stagnant, despite us having the lowest interest rates in history at 2.5% or whatever it is. I stopped looking because none of it makes sense to me. So you got the price of money so cheap that people who have borrowed to the max, their jobs aren't paying them enough to support the mortgages, or just enough to support the mortgages, so that they can't bid house prices too much higher because their wages, their income can't support it, even at these low interest rates. So what picture's being painted for you when interest rates go up and these guys are already mortgaged up to their hilt and are facing higher payment, and they're just struggling at the moment. I know a lot of people who are struggling to even make ends meet because energy's going up, gasoline's going up, food's going up, everything's going up, but the government is telling you that nothing's going up. So if you're mortgaged to the hilt and interest rates go up, you're either going to get foreclosed on, or you have to get some of your debt forgiven, or you have to ask for an extension, or you have to ask for some sort of help, some debt consolidation. This thing is just unbelievable. Some of the mortgages I see taken out on crappy houses are just unbelievable. I mean, you're basically paying $400,000 for a toilet block in the city. That's ridiculous. That's just, you have to look at, if you look at how much it costs you to build a house. I went to a showroom a couple of months ago. Beautiful 4-bedroom house. 189 square meters. Lovely, fully fitted, everything all done. $177,000 to build that house. Now, the value of the land is questionable, but just the cost of building a project house is $177,000, which is very nice. It's all new. So why is the median house price in Sydney worth $620? Is the land really worth that much? This is questionable. A lot of people say, oh man, there's a lot of demand for houses and there's not enough land. Australia is the 4th or 5th biggest country in the world. America is 15 times our population. And they're spread out. They got plenty of houses. I don't care if 90% of our continent is deserts. I'm sure you can fit the rest of it along the coastline quite comfortably, and you can see that. The government's releasing a lot of land now, which is priced, I can't say expensive, but it's expensive to what we used to pay for it. I mean, my dad paid 63 grand for his first house back in 88. It's crazy. I mean, the same house today would fetch 400 grand. This is a stupid number. So there's land. It's cheap to buy a house. So you put the 2 and 2 together, why is there a 300 grand discrepancy between the cost of a median house price in Sydney and the actual cost of acquiring just some land and to build your own house on it? It's crazy. And even the cost of building a house is coming down. But deflation is not the topic of discussion today. That's another day. So, as I said before, that's the situation in Australia. I've just read an article where the housing market in the UK is rising at its fastest pace to its highest level since the GFC. And what has the UK been doing for the past 5-6 years? Exactly what the US has been doing, quantitative easing. And where's that money being funneled into? Well, you guessed it. Stock market, housing market, bond market. Same thing. It's the same story worldwide. In Australia, our government's not really printing money. It's not monetizing debt because right now it's still not that bad in debt. So it's okay. In the future, that's going to be a questionable thing to ask, to be talking about. But that's, as I said, is a future discussion. But whatever you see in Australia, it's probably the worst housing market in the Western industrialized world. I mean, forget even looking at real estate in Hong Kong or Asia. I mean, those places are just, it's a fool's paradise. I mean, those places, there's only lemmings that live there, and there is not one single sane-minded investor out there. They're all speculators, and they're all going to get crushed when interest rates go up. So, housing market, if you wish to put money in it, I'd reconsider. And finally, I'd like to talk about one last asset class, of a very, very brief discussion, I promise. And that's commodities. And especially the precious metals, namely gold. Forget silver and platinum, I like to talk about gold. And with gold, a lot of people don't realize that gold should not be seen as an investment. Gold should be seen as a hedge. That hedge is against inflation. And if you believe that inflation is rampant out there, then it would be a stupid thing not to have a proportion of your portfolio in gold. And gold is not just an investment. Gold is simply money. And I'm gonna talk about that in the future. But just a brief rundown on why gold is money. Because in the 200 years before the implementation of the Fed in 1913 or 1914, gold has always been priced at about $19 an ounce in US dollar terms for 2 centuries. It never moved. But since the implementation of the Fed, the creation of the Fed, if you took an ounce of gold and you took the equivalent in terms of US dollars and you put them in a safe place somewhere for 100 years, which happens to be this year, and you retrieved this box and you pulled out that ounce of gold and whatever it was worth at that point in time, which was $19. That $19 is worthless. But that ounce of gold, which was worth the $19, is now worth, at today's market rate, $1,350. So that means that the Fed and other central banks have destroyed the value of the US dollar by about 96% in a century. The purchasing power of the $20 compared to the purchasing power of gold at that point in time has been decimated by 96%. And now the Fed is printing money at such an astronomical pace. The money supply is expanding like crazy. And the Fed says that there's no inflation, but inflation is an expansion of the money supply. The money supply has expanded by 55%. So therefore, not only is there inflation, there's a huge amount of inflation out there. And when you talk about inflation being the gradual rise in prices of things that you need to buy, or goods and services, it really isn't. The rise in goods in prices is the after effects of inflation. Inflation causes things to go up in price because inflation is the expansion of money supply. But that's another discussion. So ultimately, you have to own things that's going to maintain your money's purchasing power. Gold is one of them. And gold is going to keep on going up as long as the governments keep on printing, especially the Fed keeps on printing fiat currencies. And this belief that Keynesian economics, that there's a magic pill, there's a magic button that you can press, which is a printing press, that's going to solve all your problems, is going to wind up just destroying everything that the forefathers tried so hard to create. The whole American economy is just going to disappear. And it's going to happen so quick, it won't even be remembered. It's just going to be just a desert waste, a financial desert wasteland that nobody wants anything to deal with. And unfortunately, its citizens, anyway, it's a sad story, but this is not a philosophical discussion. This is a technical discussion on the principles of investing. So ultimately, if you understand now, or you know now, what the principles of investing is, and you understand the fundamentals of investing, and you have in your mind now the understanding behind why you should put money towards an asset, in that it should be giving you a positive rate of return that is greater than inflation over the course of time, then you will come to one conclusion. And that conclusion is every single asset class. And I'm not one to issue general, broad, sweeping statements, but this is one that I have to make. Every asset class, apart from precious metals and commodities, are overpriced. And they're overpriced because the Fed has manipulated interest rates. And as I said earlier, bubbles can last a long time. And if bubbles can last a long time, you may say, well, can't this go on forever? Well, it won't, because the market, once inflation is really interpreted and discovered by all these bondholders, they're just going to dump that toilet paper, those treasuries, and they just have to revert back to sound money or gold, take currencies back to gold standards. They have to, because printing money is not a solution. So what's going to happen to these overpriced assets, you may say? Well, they're going to collapse. Then just stock markets, S&P trading at 20, forget it. The only way is down. It could appreciate more, but the only way it's down. The bond market, the only way is down, and the real estate market, when interest rates go up, it's going to implode. So before you put money into any of these asset classes right now, think again. And if you already have, maybe it's time to take money off the table.